From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, October 11th, and welcome back to the HPS Macrocast. This is Tony Fratto coming to you from New York City. John Fagan and Brendan Walsh are in the HPS studio. John and Brendan from Markets Policy Partners. Guys, this is the week we've all been waiting for. China trade negotiations week finally happened at a high level. The top Chinese negotiator, Liu He, is going to be in the White House today. And the expectations in markets and among people who have been watching this, all of us have been watching this for some time, is for a mini agreement, a skinny agreement, not as ambitious as the comprehensive agreement that we set out for. And it took a lot of all of the oxygen out of the room all this week, as it has tended to do, the markets being super sensitive to any whisper of up or down move. John, walk us through, like, how did the week go, and where do we think we are today?
Thanks, Tony. Yeah, it did live up to its billing. As the Trump administration, as we all know, the Trump administration is tactically unpredictable, but sort of strategically more predictable. So if on a strategic, from a strategic perspective, if you said they're going to amp up the pressure into ahead of talks and then cut a deal at the end of this week, that would sound pretty consistent with their strategy, format that they typically follow. Tactically, what they did to ramp up the pressure was on Monday night, the Commerce Department blacklisted another set of Chinese firms, the ones that are involved in Western Chinese, what they cited human rights abuses and privacy situations and ethnic minority and in basically repression in Western China as the motivating factor for these. And that was on Monday night, and it was so it's a pretty splashy move, and it was a new justification. The Trump administration has tended to go away from or stay away from human rights and keep focusing on the economic side of things typically. And the timing obviously was pretty provocative with the delegation, with the staff level talks already beginning. The markets had some palpitations on the back of that.
Yeah, my phone started blowing up. Everyone's calling me from Wall Street. Is it over? Is it over?
Yeah, and
you're sort of seeing it as as part of a ramp up strategy to get for some concessions out of the Chinese, but yeah, it easily could have blown it up, right? I mean, Chinese could have said that these are internal matters, and they did say that, right? They put out statements to the effect saying we're not going to come in and do this agreement with you.
Yeah, there were headlines about and leaked ideas about the Chinese cutting their delegation short, leaving on Friday, maybe even leaving on Thursday, and instead of having 2-day negotiation. So the S&P 500, we've seen markets chasing headlines, and again, despite the fact that this was probably strategically rather predictable that the Trump administration would do something to amp up the drama ahead of these talks and put more pressure on the Chinese. When you actually see what the tactics that they use, it is, as you said, it's pretty high wire strategy, and so the S&P 500 backed up pretty good. It was down about 2% by midweek, but the Chinese, despite the fact that threatening to cut their delegation short, it was pretty clear that they were coming to town. There was a sense that the mini deal, which you referred to, this interim deal that we've talked about, is it's nothing is easy, but it's the closest thing to a layup they were going to get. The Chinese have obviously signaled that they're happy to buy more U.S. agricultural goods, and the Trump administration has made it, pretty clear that the tariffs that are coming into place on October 15th and December 15th are negotiable.
And the Chinese sent the whole team, right? How significant do you think that is, Tony?
It is. Some of that stuff though reminds me of the, back in the day when. Before the Fed was transparent, you'd watch CNBC in the morning on FOMC day, and and CNBC would have a camera outside the Fed with to get Greenspan going from his car into the Fed building, and they had the briefcase watch, right? And if it was and I actually can't remember. I knew back then, but I can't remember now whether if it was a fat briefcase, that meant that there was probably going to be a policy change. If it was a skinny briefcase, there probably wouldn't be a change, you know. So I get these calls too from people in the market saying, "Have you heard that that the delegation is going to be a smaller delegation, not a big delegation?" And look, in all honesty, for this deal, the contours which we could kind of, and this is talking to people who are either first or second hand knowledge of how the talks are going, and they could have sent over like a 3-person delegation to negotiate this deal, right? There isn't a lot in there. It's not new ground. It's things that had been discussed long before. The pieces are things like, and some, by the way, are actually repackaged things that happened before. Like, there's the expectation that this currency language will be, part of a package of agreements. Well, that was announced in February. Steve Mnuchin announced it, and it's basically the same language that we use in that they negotiated in the USMCA, that Canada and Mexico agreed to. So that's not really new. So there's
really a new headline this morning that it looks like the Chinese will be willing to remove the requirement for forced joint ventures by January 20th. And it's not clear whether it's just on financials. Yeah, so that's what you've heard, just financials?
I heard just financials.
Yeah,
it'd be great if it extends to others. But and again, that's another case of that was, I think, scheduled to go into effect it's a schedule.
We've been negotiating this for 10 years, and it was eventually going to happen. So you might as well throw it out.
So it was going to happen in like 2021. And so they moved it forward so that by the end of January of 2020, some full ownership of financials. Actually, some of it happened already.
Yeah.
Back in 2018, where banks, banks could own, wholly or have majority ownership of banks in China. So some of that stuff is like I said, it's really not new. On the agriculture products and tariffs, it seems like that's the meat of the agreement, that probably new tariffs aren't going to go into place. Chinese are going to step up their buying. The stepping up of buying, one is a matter of convenience, I think, and the other is a matter of need. The convenience is on soybeans. It's much easier and a little bit cheaper for them to buy American soybeans than it is for them to buy Brazilian soybeans. And at any rate, those are the American and Brazilian soybean markets are kind of complementary because of the different winter and summer schedules in the northern and southern hemisphere.
Yeah, that's a good point.
And right, so you could spread out your purchases throughout the year instead of buying them all at one time. So it makes it a little bit more efficient. That's the convenience. The need is on pork products, which has less to do with the restriction or the tariffs and the bludgeoning of tariffs by the Trump administration, that it has to do with the fact that there's this pig disease in China that's really, really damaging their the swine sector in China. So that's a very big protein. The major protein in China is pork, and so they need to buy it. So it's more out of need than it is deal or no deal. They were going to have to buy more pork on the global market, and we're the world's second biggest pork producer. So
we've gotten these are the contours of the deal. It's whatever the final formulation is remains to be seen if they do get it done as we're assuming here today, and certainly the markets are assuming. The Dow is up, the S&P 500 are up almost 1.5%, retracing all of the losses from earlier this week, and this is kind of true to form. Of markets being very reactive to headline by headline, equity markets in the U.S., for instance. But we've gotten questions from clients along the lines of, if this is such a non-ambitious deal, it's a bunch of, as you said, Tony, things that had maybe already been agreed or in principle or pretty much on the table. How much upside is this? How much upside impetus is this really going to put underneath global risk assets? on a sustainable, on a medium to longer term basis. And I think that's a fair point. We've seen the equities are comfortable with the status quo right now, but there's clearly concern that the damage has been done the damage is continuing to feed through on the economic level. And on a corporate earnings level as well. And next week we'll talk about what's coming up next week. But third quarter earnings season is coming up, and we're probably going to hear a lot about the impact of trade.
I think what's clear is that what nobody needed, whether the Chinese or Americans and market participants, I think recognize this, is they didn't need to see things getting worse. As much as so I don't want to minimize this agreement I think we need to be just clear-eyed about what exactly it is. It's a positive step, actually. It's a good thing that they're going to get this agreement, I think. You can make a case that once you start having agreements, you can start working on other agreements that can create impetus and momentum for further discussions. And that's certainly, I think, what they're going to come out and say today, and they'll be hopeful on that they'll continue discussions on this for some time. You could also make the case that maybe they're taking the sugar out of the mix, and it will make it harder in the future on these much more difficult structural issues, in China, and the things that really upset Americans on additional market access. Although there's some speculation there might be some market access things in here also for autos, although I don't expect that to have much of an impact in China. But on market access, on some of the other structural reforms, on subsidies, indirect subsidies, there's still a lot for them to talk about that are significant issues. But from a political standpoint and from a macroeconomic standpoint, putting some of this in the rearview mirror at this moment in time, as you notice, if you're an equity investor right now, you're wondering where this market is going to go in the medium term. You're wondering what the macro environment is going to be in the medium term. Look, it seems pretty close to consensus that manufacturing is in a recession, and I think Wall Street Journal economist survey came out today where the overwhelming number of business economists, their expectations are that the surprise will be out to the downside on their predictions for GDP in the future. So we didn't need more trade turmoil.
Yeah, and the president obviously is under domestic political pressure here, and that when that first broke, there was a question, and we talked about it, whether he would get more aggressive against China as almost a distractor to take focus away from the impeachment stuff. The consensus now is that putting the Chinese trade things on the back burner, at least through year end, gives them additional bandwidth to do other things that they may need to do on the home front.
All right, that's the economics. Let's take a break. When we come back, I want to get into what happened with China and the NBA this year and what firms are dealing with in China. You're listening to the HPS Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Microsoft News Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, welcome back to the Macrocast. This is Tony Fratto, New York, John Fagan, and Brendan Walsh with Markets Policy Partners in Washington, D.C. Can we talk about the other big, China news this year? We always think about, we think the whole world is interested in, either economics or politics, and we forget that culture, sort of dominates all of those things. And with this really crazy situation with the NBA this week, which brought into relief, I think, some of the things that a lot of American firms, not just American firms, Western firms operating in China have to deal with. And this was this, everyone knows the story. It was the GM for the Houston Rockets put out a pro-Hong Kong freedom tweet that was pretty innocuous, but really rankled Chinese authorities. And this question of firms operating in China, they're the economic pressures, but they're also the cultural pressures of doing business in what is an enormous market. It will be the world's largest market, world's richest market. And so you have to be in there. And that means sometimes you have to deal with some of these local issues in China, which are at minimum bothersome, sometimes really offensive. Their treatment of minority populations, the Uyghurs and others, the limits on freedom of speech, the limits on media, freedom of the press, the things that freedom of religion, the things that we take for granted. All of the First Amendment protections that we enjoy here that don't have the same level of protection there, and it's really challenging for firms to deal with.
No question about it, and certainly the NBA issue, and also the fact that Apple pulled one of the apps that was used by protesters in Hong Kong to locate police resulted in some furrowed brows in the policy community for sure down here in D.C., and it sent. It obviously sent a pretty clear message to corporate America. Policymakers have to be sensitive, and they are sensitive clearly to the fact that corporate America can get caught in the middle of this tussle and end up being pawns. Certainly the U.S. has been more aggressive, I think, in some ways toward Chinese companies specifically, and the Chinese haven't played that card to a great degree. We've heard that a number of different times from analysts. As we've said, They haven't beat up on China. State media hasn't rounded onto focusing their ire on U.S. companies to the extent that they may be capable of doing, and certainly that's something that U.S. companies want to be able to not have to choose sides here. But it's going to be potentially increasingly difficult to do that going forward. This is not a costless, to the extent that the U.S. is having a multi-front economic confrontation with China. This is not a costless kind of policy approach, and coming clean with the kind of and having a clear-eyed view of the kind of costs and benefits of it. I think needs to be ramped up in the policy discussion.
Yeah, I think it's what what's hard for firms is that there was a time, and truthfully before social media, you could have essentially local policies in each of the countries you're operating that just conform to what the local policy is. Today, you can't. I mean, it's not. You could try to treat it like many markets, but really, you're living in one market. You're, the citizens of the countries in which you're operating are seeing all of the same things at all of the same times. The employees are seeing all of the things at all of the same time, and you're being judged on those things. Political actors are seeing all of it at the same time. So it's really challenging. I mean, our advice has been to companies is to be just very clear and transparent about what your principles are and live and die with them. To your point, it's not costless at all. It may not be maybe significantly costly to the NBA to be forced to make clear that it has a principle of that they support freedom of speech for their people. Like that's an important principle. It probably is going to cost them in China. Although I will have to say, that the Chinese government, and I don't want to minimize that Chinese people may have been upset by the tweet. The Chinese government reacted in a fairly big way with loud statements and taking the preseason NBA games that were being played in China off the air, off of CCTV, and pressuring some of the Chinese advertisers to pull back their advertising of the NBA. At the same time, you watched we saw the NBA game the other day. It's a sold out game, and they love the NBA. There's only one NBA. It's a great game. It has the greatest stars in the world. And so NBA basketball fans in China love the NBA, and the NBA is a huge investor in growing basketball in China with the domestic league in China, also. So, the NBA is they're not going to get kicked out of. I don't think they're going to get kicked out of China.
Yeah, I think Daryl Morey kind of gave them a gift where they knew that the NBA wasn't going to stand up to them. It's as much as I guess if this whole thing went through, the salary cap could go down as much as 15%. So this was a great opportunity to slap the NBA on the hand and then quietly down the road figure it out. But now you're sending a message to every other U.S. company saying, okay, if you want to play this game, see what we can do to you.
Yeah, well, it is a wake-up call. So if you're an American firm in business in China, if you didn't have a policy on these kinds of issues, now's a good time to get one.
Yep.
because you're probably going to be asked, and there could be another event, and people are going to be on the lookout for tweets from your the manager of your plant in whatever country, and to see what you say about things, and so now's a pretty good time to get a policy on it. Why don't we take a break? We're gonna. There's still so much for us to come back and talk about. You're listening to the HPS Macrocast.
HPS is seeking a mid-level public affairs professional to join our dynamic team. If you have 5 to 10 years of management experience in communications and you're interested in the topics discussed on the HPS Macrocast, this just might be the role for you. Apply today at hamiltonplacestrategies.com/careers.
All right, welcome back to the Macrocast. This is Tony Fratto, New York, John Fagan, and Brendan Walsh with Marcus Policy Partners in Washington, D.C. We had some Brexit news this week, and we're in the countdown. But the countdown, everyone's pointing to October 31st, but really, we're going to know a lot by next week with the EU leaders meeting. Is the UK Prime Minister Boris Johnson, Bojo, making any progress?
Well, it seems as though he is unexpectedly. Market participants have gotten a little bit of whiplash this week following Brexit news, kind of like they've gotten whiplash following the U.S. China trade negotiation headlines. And the whipsaw really came at the beginning of the week when headlines emerged that Angela Merkel had taken a very hard line on a phone call with UK Prime Minister Johnson and telling him in no uncertain terms that Northern Ireland must forever and ever and always be within the customs union and so forth. There seemed to be some head scratching from European sources
and the Europeans and everyone else,
saying that did she really say that? And some question about whether there was blame game going on. There were quotes from 10 Downing Street saying that this was the absolute end of the road for negotiation, and an irreparable impasse and rift and so forth. So that was how the week began. And then on Thursday morning, there was news from a personal one-on-one chat and stroll at Boris Johnson, Prime Minister Johnson's country house. He and his Irish counterpart. How do you pronounce it? Boy.
Trying to figure it out.
Yeah, sorry. His Irish counterpart took a stroll through the delightful grounds of his country house, and they managed to find a pathway, and that pathway was toward a potential Brexit deal. And when the headlines emerged, it was a big surprise, and the pound jumped. It moved up almost 2% against the dollar in one session, which is a pretty huge move. And it's up almost 1.5% again today, as the EU Council President Tusk has also cited meaningful progress, and there's a sense that maybe they're going to be able to figure out the absolutely thorny and bedeviling issue of the Irish border. And it's not entirely clear what the UK has the UK government has moved and conceded on. It's a fuzzier sort of fudge in which
or if it can make it through Parliament also.
Right. Yeah, but the time frame is really short. And as you said, Tony, the EU leaders meeting is next week. The Leaders Summit is next week, and it has to get through Brussels and it has to get through Parliament. And the deadline is on October 31st. And if they get some sort of delay, even a delay to negotiate, that might still be the opening for the Labor leader Corbyn to push for a general election or something else. So it's going to be kind of a nail biter.
And who knows, right? I mean, we don't know. We don't know what their reaction is going to be to that. It's hard. I don't think there's any way to predict that right now. He is certainly, pretty unpredictable. I mean, it's hard to know how he is going to impact those discussions in the sense that they find him pretty offensive. Right?
Right.
Yes, it's just like the episode with Angela Merkel earlier this week is a perfect example. They don't really like him very much, and it's because they keep they do these kinds of things where he's sending mixed signals and trying to undermine discussions for his domestic politics, and it drives him crazy.
It's so hard as an investor to have some sort of Brexit base case. It's very difficult to handicap it with something like we talked. There are all these different mental exercises that investors go through when they think about their investment decisions, and one of them that I always used and is kind of a classic is, what if I make a bet and I end up being wrong, which way being wrong would make me feel stupider? And, certainly like betting, if you were to come into this week and bet against a U.S. China trade deal, you'd feel pretty dumb once, if President Trump is smiling with Liu He and the photo opportunity, because you've just seen that happen again and again. So past experience would dictate that your base case really is that they get something done. There's, I think just with Brexit, just observing it makes you feel dumb. It's just there's no good. There's
in 10
no
years,
good way
your
to.
child asks you, Daddy, why did we lose all our money? And she saw a picture of Boris, and she said, "You bet with this guy? You had your faith in this fella?"
We've seen the way that markets reflect Brexit risk. Obviously, the pound is the high frequency barometer of Brexit fortunes, and the options markets are still pretty skewed though, and net speculative positioning is heavily betting on further weakness. Mm-hmm. And you can kind of justify that by saying, well, even if they get a Brexit deal, the UK economy is going to suffer. The Bank of England is probably going to be coming in with rate cuts, that sort of thing. But the pound is already so low, and positioning is, pretty heavily against it. And so you get good news like this, and it just bounces up like a coiled spring. And when you look through the rest of the UK asset complex, there's some, obviously the equity market is reactive to it, but certainly less than it used to be. And when you look under the hood at the much more systemic parts, if you're looking at credit default swaps, the cost to insure the debt of UK-focused financials or the UK government itself, there's no indication that this is a structural risk, that there is a real, banking crisis or some other, something really structural and fundamental that would break if they go through Brexit. It looks much more like the markets are pricing a cyclical risk. And I think that's pretty consistent with the kind of I think that's consistent with the fundamentals.
Yeah. Hey, let's. I want to do a quick turn, come back to the United States, and talk about where the Fed might be heading, and some of the news that we got on inflation, and whether we're able to make a case. The Doves can make the case for for more rate cuts going forward. Is that what we're seeing right now?
Yeah, definitely. We got the consumer price index, which on the headline was about 1.8% on a yearly basis, but the core was still 2.4%. So on that front, the inflation is not justifying a cut. However, they focus much more on the personal consumption expenditure index, which is below the Fed's 2% target. Kind of the rest of the data, I would say. So right now the odds are about 80% for a cut in October. And Chairman Powell gave a speech this week, which kind of didn't dissuade the market that they're correct, that we're getting the one in October. And if we don't get the one in October, almost you're guaranteed, I would say, to get the one in December. So whether it's justified or not, from an economic fundamentals, it looks like due to the liquidity constraints in the funding markets, Chairman Powell has the justification to do at least one more rate cut this year.
Do you think taking tension off on the trade front mitigates that at all?
For 2020, I think it's a big deal. For the fourth quarter of 2019, I think that the market's almost going to force them to do what they've already priced in.
Okay, well then we'll see. The truth is, as you think about whether taking tension off the trade front would mitigate it, presumes that we are actually going to take it off. Then today there is actually going to be an agreement. So
right.
I'm going to put,
and the details of the agreement matter. So if we just freeze tariffs where they are, that still is going to be a negative for the global manufacturing. If they actually remove them, then that's a totally different scenario. Then you could actually see 2020 growth accelerate, because you combine the elimination of the tariffs with a pretty large, not just Fed, but global central bank easing throughout the course of 2019. So you could see a pickup in 2020, which means the Fed would obviously not have to hike. I mean, to cut in 2020. In fact, they might actually have to be, this time next year, we might be talking about hikes again.
That would be wild. I'm not expecting it, though, and I'm not expecting. I think that if they're successful today, I think that means we won't see new tariffs coming on, but we're still going to see a lot of tariffs in place for
that's our base case.
Yeah. Lingering uncertainty, the to-do list of all the unaddressed structural issues that the U.S. has demanded, structural reforms that the U.S. has demanded of China, that's all going to still be out there.
Yeah, so there's a long road ahead. Well, we'll know a little bit more about it by this time next week. We will. Why don't we come back next Friday? We're going to get a little bit more news on we'll know what happens with the China trade front if it's not blowing up right now while we're recording this podcast. We'll know a little bit more on Brexit, and I think we'll have a little bit more insight on where the Fed is going. I also want to get into next week a little bit more on some of the geopolitical risk. We didn't get into Syria, Turkey, and some of those issues today, but I definitely want to come back next week. We're going to have the IMF World Bank meetings going on in Washington, so a little bit more of a global outlook next week.
Yeah, we joke that that Jobs Friday is like Christmas morning for economists. Well, the IMF World Bank Washington D.C. is kind of like Fat Tuesday for us, right?
Yeah, it's like Burning Man for economists.
That's right. We might have to do two shows next week.
Yeah. A lot of cocktail parties.
John Fagan and Brendan Walsh at Markets Policy Partners. Thank you. Tony Fratto with Hamilton Place Strategies. We'll talk to you next Friday. Thanks, guys.
Awesome.
Thank you.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @Tony Fratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.